On paper, a bank might report record profits and flawless reserves, but behind those quarterly reports, the actual vault is sometimes completely empty. To understand how a bank loses its money in plain sight, we have to look at non-performing assets, or NPAs. In plain English, an NPA is simply a bad loan. The borrower has stopped making payments, and the bank is holding the bag. But banks are terrified of looking weak to investors. Instead of writing off the bad loan, they engage in a practice called loan evergreening. The bank provides the bad borrower with a new loan specifically to pay the interest on the old defaulted debt. On the balance sheet, the borrower looks current and the loan looks healthy. In reality, the bank is bleeding its own capital to artificially prop up a zombie company. The bank stops acting as a strict financial gatekeeper. Instead, it becomes a complicit enabler, hiding individual corporate failures until they accumulate into a systemic ticking time bomb. This accounting trick might survive if it's limited to small businesses, but the system fractures when banks extend this reckless courtesy to high-profile, ultra-wealthy clients. In India, the ultimate stress test came from Vijay Mallya and his flagship company, Kingfisher Airlines. Kingfisher was burning cash at a rate that quickly outpaced the bank's ability to quietly evergreen the loans. The scale of these defaults finally exposed the total lack of credit risk assessments taking place behind closed doors. Once the illusion broke, the scale of the damage was exposed. Indian nationalized banks realized they were trapped in a 1.55 lakh crore rupee debt hole. Kingfisher's collapse served as a global alarm bell. It proved that the ledgers of India's most prominent financial institutions were built on a foundation of hidden losses. The crisis forced an immediate regulatory crackdown. The Reserve Bank of India stepped in, ending the evergreening cycle and forcing banks to declare their true losses on paper. But admitting the money is gone is only the first step. The immediate logistical nightmare became, how does a bank legally force wealthy, entrenched defaulters to pay it back? Looking at this table of India's debt recovery performance, we can see the failure of their first tool, the Debt Recovery Tribunals, or DRT. The bottom row shows a recovery rate as low as 7%, with cases agonizingly stretched over 3 or more years. Staying on this data, the row above it shows the second tool, SARFACI. While the recovery numbers were better, it lists high court writ interventions as the primary hindrance, meaning defaulters constantly used the courts to stall the proceedings. The entire legal framework rewarded delay. Stealing $1 billion rupees was easier and much faster than a bank trying to legally recover it. To bypass this broken tribunal system, the government introduced the 2016 Insolvency and Bankruptcy Code, or IBC. The IBC was designed to be uncompromising. Instead of endless negotiations, it resolves insolvencies by stripping total control of the company away from the defaulting promoters. Returning to our recovery data, the top row shows the upgrade. The IBC successfully recovers up to 38% of claims, nearly tripling the performance of the old DRT framework. Yet, there is a harsh reality on the ground. The IBC legally mandates a 330-day timeline to resolve a case. In practice, the process drags for up to 840 days. Because the IBC is the only tool that works, it is choking on its own success. The system is currently struggling under a backlog of over 30,000 pending cases. India built a financial weapon with the teeth required to claw back billions, but right now it lacks the bureaucratic capacity to process those cases quickly. While the bureaucratic delays are frustrating, the macroeconomic aftermath shows the true impact. What has this law done to the nation's bad debt crisis? This statistical analysis table directly links the existence of the IBC to the decline in gross non-performing assets. If we look specifically at the Pearson correlation row, we see an R value of negative 0.817. This line graph visualizes that negative 0.817. There is a proven inverse relationship. As the IBC becomes more effective at threatening takeovers, the volume of bad debt shrinks in parallel. The data proves that the threat of seizure acts as a potent deterrent. Borrowers are finding the money and settling their debts before they ever see the inside of a courtroom. The final outcome of this regulatory crackdown speaks for itself. India's bank NPAs have shrunk from crisis levels down to 2%. The shelter once provided by evergreening has vanished. Banks have lost their ability to hide losses in the shadows, and the pattern of billionaire bailouts has been broken. There are still hurdles ahead. The legal machinery of the NCLT and DRT urgently requires substantial staffing increases. If they don't clear the 30,000 case backlog, the bottleneck itself could spark a new crisis. Stability is built on a foundation of enforcement. By maintaining the legal capacity to carve out corporate rot, the system prioritizes transparency over a comfortable lie.